time for making sound decisions about your asset allocations are not when there's a big swing downward or, for that matter, upward in the stock market.
Go ahead,
a healthy balance between stocks and bonds and money market, and the burden of proof is on changing it, not on staying the same.
Can we ask, and I know you're not an economist and you do not personally manage any mutual funds that you have at Vanguard, but what are you expecting? Are your experts telling you that we are in for tough times ahead, or that things are just going to get better? We had a shakeout, it was short, it was hard, but it's over.
I think the general opinion, and you get an awful lot of opinions when you sit in my chair, the general opinion is that the recession is going to take much longer to get over than most people expected. And with stocks selling at relatively high price-to-earnings multiples, say 18, 19 times earnings, which is a relatively high level, this is a time when we might have to look at stocks consolidating for some period of years.
All right, John Bogle, thank you very much, Chairman of Vanguard. Appreciate you taking time with us this morning.
Okay, nice to talk to you, Gail.
Gentlemen?
Okay, Gail, thank you very much.
Okay, when we come back, we're going to have some more technical analysis with Steve Shobin of Merrill Lynch, a special options report with our own Bill Griffeth and Allan Chernoff. We'll have a live report on today's trading from the floor of the New York Stock Exchange.
Right now, in fact, you're looking live at the floor of the American Stock Exchange, where the market has been open just 1 hour now. It's about 27 minutes past the hour. The Dow currently trading down almost 10 points. Stay tuned for more.
The Sony Trinitron XBR television. Simply brilliant.
Get ready for the most powerful investment tool you'll ever use. Add Express to your personal computer, and you've got a 24-hour financial information service right in your home. Fast, accurate, easy to use. Express gives you an insider's view of what's going on whenever you want it. Take charge of your financial future with Express.
Call Express now for a special introductory offer. 1-800-7PC-NEWS.
Investors, let Value Line help you pinpoint stocks that could score big price gains. We'll rush you, as a bonus, our new ranks of 1,700 stocks for price performance in the next 12 months. We expect the 100 top-ranked stocks to outperform all the rest, but avoid the 400 lowest. Value Line has ranked stocks this way for over a quarter of a century with these powerful results. And here's a second great bonus. Value Line's current full-page reports on 1,700 stocks, each with up to 15 years of statistics, fully indexed for you in this giant reference set. Your reference will be constantly updated with more than 100 new stock reports sent to you each week. To get this reference set and new performance ranks as instant bonuses, try Value Line for 10 weeks, now only $55. Call 800-472-7753 right now and get J.K. Lasser's brand new tax guide as an extra bonus. 800-472-7753. Call now.
Welcome, everyone, back to this hour of the Money Wheel. I'm Neil Cavuto for Ron and Sana.
And I'm Doug Ramsey. Here's what's topping the news at the bottom of the hour. As promised, it's shaping up to be a very interesting day of trading on Wall Street. Stock prices opened higher today after the Dow Industrials took its 5th sharpest point decline in history on Friday. The Dow rose 2 points early in the session to 29.45. That's right at the opening bell. Then shot up over 20 points on heavy volume, only to lose that ground and head quickly into negative territory on some sell programs. Right now, the Dow Jones Industrial average is trading down 7.60. Taking a look at how some Dow components are trading, machinery giant Caterpillar is currently trading down a quarter at 43 7/8. Goodyear is down $1 a share at 47 1/4. Minnesota Mining and Manufacturing, 3M though, is up 1 1/8 at 88 1/4. And United Technologies is down 1 1/2 at 47 1/2. For more now on how investors are reacting to today's action on Wall Street, we go live to the New York Stock Exchange where Allan Chernoff is standing by. Allan.
Thanks, Doug. First of all, there's a sigh of relief here because clearly we're not having any major plunge in the market, and that had been feared by many investors. So that is not happening so far today. What we are having right now is a battle between bargain hunters hoping to snap up shares that lost quite a bit on Friday, and on the other side, money managers who are really acting as preservationists. There are only several weeks left in the year, and the money managers desperately want to hold on to the gains. It's very important how they do at the end of the year. That's how their clients decide whether or not to keep their money with these money managers. So these money managers will be very conservative between now and the end of the year. And one good example of that is what's happening in the financial services stock. Merrill Lynch, for example, is down more than 2 points today. It's not that the fortunes of Merrill Lynch have suddenly changed so much. It's just that the stock has done so well, so many money managers are taking profit in that. Payne Weber also had been hit earlier today. The other stocks that are really getting it today are still those biotechnology stocks. Immune Response off 2 1/4. Chiron Corporation down 2 points. The biotech stocks, boy, they've really climbed this year, and now they are still losing lots of their energy in the market right now. Longer term, a lot of traders are saying that we could see a correction in the market, 10 to 15%. But the idea is that today, at least, we're not going to experience another crash. Back to the studio.
Okay, Allan, thanks very much. Allan Chernoff standing by at the New York Stock Exchange. Neil.
All right, taking a look at the Dow Jones Industrials and other key averages we're following for you. As Allan pointed out and Doug reiterated, we're not really seeing anything like we saw Monday, October 19th, 1987. There is no follow-through sell-off. This is really showing the first half of the chart where the Dow Jones Industrials fell on Friday and the pickup today. We're down a tad bit further, about another 8 points further than where we were. Now, not really any of the dramatic losses that we had envisioned happening. It's again early in the trading day, but taking a look at some of the other market averages in the meantime, we've got a sense that the market as a whole is holding its own with some nominal losses in the likes of the utilities and elsewhere, down about 1.19 at this 3/4. The transports, though, largely rocked on losses in both the airline issues and majorly in what's been going on now in some of the rail issues, with the likes of at least Conrail down better than 1 3/4 points at 13 2/3 points south now at 1211.88. And the industrials, as I say, 2941.19, down a little bit better than 2 points. Some of the other market averages shaping up like this. The NYSE Composite has surrendered about 1 1/5 points at 210.70, but relatively holding its own over the last roughly 30 minutes or so, which is more than you could say for the market performance late yesterday or Friday. We've got volume thus far relatively heavy at 78.5 million shares changing hands. Elsewhere, checking some of the other advanced decline numbers, running better than 2 to 1 now, negative about 2.5 to 1 negative. We've got 421 issues unchanged on the day. And taking a look at the other averages, we've got the S&P 500 slipping 2.5 at 380.17, the Amex down nearly 5 at 376.21, and the NASDAQ at 525.66, down better than 5 2/3 points. The long bond is down 8 ticks at 101 29/32, with the yield inching up to 7.83%.
And standing by now in our Wall Street Bureau for a look at the stock market from a technical perspective is Steve Shobin, First Vice President and Technical Analyst with Merrill Lynch. Steve, thank you very much for joining us today. How does this open look to you from a technical perspective?
Well, the opening is, as you said, a bit of relief, but I think we can draw make more important conclusions by looking at prior examples and seeing where this one might fit. If you look at all of the big down days in the past 6 years, unfortunately, there is no consistent pattern. Sometimes the big crash day was a good buying opportunity. Other times it was just part of an accelerating decline. Number two, even if the big crash day was a good buying opportunity, one need not jump up and do a lot of bargain hunting at that point. You almost always had a test of the lows in 2 or 3 weeks following that big down day. And one final observation I'd make, most of the prolonged, extended declines where you saw a lot of residual weakness following the big crash day were characterized by one thing, a very, very weak bond market. And that's something we don't have right now. And I think that's where we can find some solace.
Where do you see us testing a lower? How far down could we go, whether it's in the next couple of days or the next few weeks then, when you look at your charts, where could this bottom out here?
I would say, and I know this is a very, very broad area, somewhere between 28.70 and 29.30. I don't look for, my guess is probably not much more than another 2.5% on the downside. And I think after that we'll go through a period of basing and testing and backing and filling, and then I think we have a shot back up to the highs. But we could come down another 2%.
So you're really not talking about this, I guess, a major correction that a lot of people have been expecting at some point, since we are so near their all-time highs in many of these averages.
I am party to that major correction, but I think it's going to be way down the road. Since May, I've been talking about a big top ever since the Dow got to 3,000, but some things in terms of a top are still missing. One, we don't have a lot of dramatic divergences. Two, we don't see a serious breakdown in bonds. Three, we have not broken a key support level. And four, we have not had a period where laggards dominate the tape. Usually at a top, you'll see a lot of out-of-favor stocks performing well at the expense of the leaders. I think when those things happen, the top will be complete. But until then, it's probably a trading range, 2850, 3100.
Very quickly, what is the next support level on the Dow that you see out there that we ought to be looking at?
Around 2920, 2930, in that area.
Okay, Steve Shobin, First Vice President and Technical Analyst with Merrill Lynch. Thank you very much for joining us today.
All right, Bill Griffith now joins us for a special report on action in the options markets. Billy?
Wanted to get a feel, guys, for what the options market may be saying about this market right now, whether or not we have, in fact, seen a bottom here and what the sentiment is, because the options market has a lot of sentiment built into it, as you know. So I called a lot of the usual suspects this morning and to get a feel from them what Friday's market action was all about and what, based on the options activity that we saw on Friday, what it could mean for the future of the market. I've got three different indicators to tell you about this morning that we usually visit with throughout the week. Let's get to them right now. First, how much volatility we saw on Friday and what it could do to premium levels of options, and that has a big sentiment factor for the options market. Now, on Friday, these are the call and put premium index numbers that we quote you each Wednesday. The numbers on the left are the result of Friday's activity, and the numbers on the right are the most recent from Wednesday. Now, usually you do not get as big a jump in the premium index numbers on the calls as you would get as we see here. So we saw a jump in call premiums. Now look at the puts, though. They were down on a big down day like we saw. We saw more call buying than we saw put buying, or at least in terms of these numbers here. That's very interesting. That could be rather bullish at this particular time. Let's go to the Ansbacher index. The reading from Friday was a 0.65. Now it reads a lot like the ARMS index. The further you go below 1, the more bullish the reading. Now that looks very bullish at a 0.65, although I will point out that when we quoted it just the day before, the reading was even more bullish. This is a price indicator. This is an indicator, a comparison of prices of the OEX, 15 points in the money, both the puts and the calls on the most recent month. So this is for November at this point. So the reading, while very bullish on Thursday, not as bullish on Friday. Very interesting. The more interesting one, and I don't have a chart to reflect this, is an indicator that John Bollinger put together, and it has to do with put volume in the markets. When the put volume on a big selling day doubles its 10-day moving average, there usually is a bottom in this market. And just to give you some perspective, on the October 19th coup attempt in Russia, John almost got a buy signal when the put volume there was at a 1.9 ratio to its 10-day moving average. This time, 2.8. Very, very bullish from John Bollinger's perspective. So some mixed signals in the options market. One indicator says very bullish, another one rather mixed at this point. So we'll see what the options market tells us down the road.
Okay, Bill, thank you very much. Check in with you a little bit later, too. We've done options, we've done stocks. When we come back, more on the credit markets from Neil Cavuto. Stay with us.
Almost every year, something very interesting happens to the stock market in January. Around New Year's Day, average returns on stocks tend to go up, dramatically more than in any other month of the year. It's called the January effect, and historically it has presented a significant investment opportunity. Research shows the January effect is strong.